There's a pattern in banking that repeats every generation. In 1929, millions of Americans woke up to find their life savings gone. Banks collapsed, panic spread, suicide rates spiked. In 2008, it happened again. Different technology, different regulations, but the same pattern. And in 2025, we're watching the pattern unfold for the third time. The warning signs are identical: debt levels, risk concentration, regulatory blindness. This isn't speculation, this is mathematics. Banking crises follow a 5-stage pattern. Stage 1, excessive credit expansion. Stage 2, asset bubble formation. Stage 3, the sudden shock. Stage 4, the cascade collapse. Stage 5, the bailout, and the debt explosion. Stage 3 has already begun. The pattern says what comes next. The only question is, will you be ready? People think banking crises are caused by bad actors, greedy CEOs or corrupt politicians. They're not. They're caused by incentives and mathematical certainty. Here's how it works. When you lend $10 but only hold $1 in reserve, when profits depend on loan volume, not loan quality, when bonuses reward short-term gains, not long-term stability, the system doesn't just encourage risk, it requires it. Banks operate on a simple truth. Most people never withdraw their money at the same time, so they lend out 90% of deposits. They earn interest on money they don't actually have. As long as confidence holds, the system works. But confidence is fragile. When credit is cheap, everyone borrows. Governments expand spending. Corporations take on debt for growth. Families buy homes they can barely afford. Banks lend more because the profits look safe. Regulators relax because the data still looks good. Risk models say everything is fine. Until it isn't. Every cycle begins with the same illusion, that this time, risk has been eliminated. New financial instruments, better regulations, smarter models. But in reality, risk hasn't disappeared. It's only been transferred, repackaged, buried deeper. When interest rates rise, or when growth slows, or when a single bank stumbles, the illusion cracks. That's when stage 3 hits, the sudden shock. And here's what most people don't understand. Once panic begins, no regulation on earth can stop it. Because banking doesn't run on math, it runs on trust. When depositors lose trust, they withdraw. When one bank fails, they question all banks. When fear spreads, money moves faster than any policy response. The cycle is predictable. The only variable is timing. And right now, all the warning signs are flashing. The 1920s looked unstoppable. The roaring 20s, credit booming, markets soaring, optimism everywhere. New technologies, radio, automobiles, electricity were transforming America. Stocks became the symbol of the American dream. Everyone wanted in, but most people couldn't afford to buy stocks outright. So brokers offered margin accounts. 10% down, 90% borrowed. Banks encouraged it. Brokers advertised it. The more people borrowed, the higher stock prices went. The higher prices went, the more people borrowed. Classic stage 1 and 2, credit expansion, asset bubble. Then came October 1929. Stock prices crashed 25% in 2 days. Margin calls flooded in. Investors who borrowed couldn't pay. Brokers liquidated their positions. More selling triggered more panic. The stock market collapsed, and with it, the banks. By spring of 1930, over 5,000 banks had failed. Depositors camped outside bank doors in winter, some for days, watching tellers pull curtains closed, watching neighbors leave empty-handed, faces drained. Farmers lost their land. Families lost their homes. Entire towns lost their savings. But not everyone lost. The strong ate the weak. J.P. Morgan bought failed banks for pennies on the dollar. John D. Rockefeller accumulated assets at 10 cents on the dollar. Collapse isn't equal. Crisis creates opportunity. Someone always profits. The U.S. government responded too slowly. Instead of spending to stimulate, they cut budgets. Instead of saving banks, they let them fail. It made everything worse. Stage 3, the shock. Stage 4, the cascade collapse. Stage 5, government intervention that came years too late. By 1933, unemployment hit 25%. A quarter of the workforce had no income. Bread lines stretched for blocks. It was the blueprint. Debt leads to bubble. Bubble leads to shock. Shock leads to collapse. Collapse forces bailout. The first full cycle was complete, and the world learned nothing. 79 years later, the pattern returned. New tools, new names, same greed. This time, banks had discovered financial alchemy, securitization. They bundled thousands of mortgages together, sliced them into pieces, sold them as bonds, and rating agencies stamped them AAA, the safest investment grade. It was magic. Risky subprime mortgages transformed into safe assets. Home values soared. Credit flowed like water. Families bought houses they couldn't afford. Banks didn't care. They sold the loans immediately. Wall Street didn't care. The bonds were rated safe. Rating agencies didn't care. They got paid per rating. Regulators didn't care. Everyone said the models worked. Everyone believed housing prices could never fall nationwide. It had never happened before. So it couldn't happen now. Stage 1 and 2 again. Credit expansion. Asset bubble. Then interest rates ticked up. Subprime borrowers started missing payments. Foreclosures began rising. At first, Wall Street ignored it. Contained to subprime, they said. It wasn't. September 15th, 2008, Monday morning. Lehman Brothers, 158 years old, $600 billion in assets, filed for bankruptcy. The fourth largest investment bank in America, gone overnight. Within hours, panic spread globally. AIG, the world's largest insurer, needed $85 billion just to survive the week. Money market funds, considered safer than banks, broke the buck. Their value dropped below $1, something that wasn't supposed to be possible. Interbank lending froze. Banks stopped trusting each other. Credit markets seized up entirely. By Thursday, Treasury Secretary Hank Paulson told Congress, "If we don't act immediately, we may not have an economy on Monday." ATMs across America were 48 hours from shutting down. The global financial system was 3 days from total collapse. The Federal Reserve acted. They flooded the system with liquidity, $700 billion in bailouts, zero interest rates, quantitative easing. Stage 5, the bailout. The market stabilized, banks survived, the economy recovered, eventually. But here's what nobody talks about. Bailouts don't end the pattern, they extend it. Because when you reward failure with free money, you guarantee the next bubble. From 2008 to 2020, global debt doubled. Central banks kept rates near zero for over a decade. Risk didn't disappear. It moved into private credit, crypto, shadow banking. The system looked healed on the surface, but the foundation was weaker than ever. Fast forward to today. Global debt has reached over $350 trillion. That's 3 times global GDP. Debt growing faster than the economy that's supposed to service it. Commercial real estate loans alone exceed $18 trillion. Office buildings sit empty. Vacancy rates at record highs. Remote work has permanently changed demand. But the loans? Still on bank balance sheets. Still valued at pre-pandemic prices. The losses haven't been recognized yet. They're coming. In March 2023, the tremors began. Silicon Valley Bank collapsed, then Signature Bank, then First Republic. Three of the largest bank failures in U.S. history, all within weeks of each other. The media called it a crisis. The Fed called it contained. It wasn't a crisis. It was stage 3, the sudden shock. And we're still in it. Deposit flight is accelerating. Customers are moving money from regional banks to mega banks, from banks to treasury bills, from dollars to gold. Investors are hoarding cash. Credit is tightening. Lending standards are rising. Central banks are trapped. Raise rates further, and you break the commercial real estate market. Cut rates now, and you reignite inflation. There's no easy path. Every choice leads to pain. Here's what most people don't realize. Look at your banking app right now. See that number next to your account? It's not money. It's a promise. A promise that when you ask for your funds, the bank will have them. But banks don't hold your money. They lend it out. And when promises break, they break fast. Silicon Valley Bank went from adequately capitalized to insolvent in 48 hours. Not weeks, not months, 2 days. When trust evaporates, speed is everything. Digital banking means a bank run can happen in hours, not days. And we're approaching stage 4, the cascade, where one failure triggers the next. Commercial real estate defaults will hit regional banks first. Regional bank failures will spread to larger institutions. Derivative exposures will amplify losses across the system. Currency mismatches in emerging markets will create global contagion. It's all connected, all wired together. When confidence finally snaps, it will happen faster than 1929, faster than 2008. No announcement, no warning from the Fed. Just silence. And then the screens go red. History shows how this ends. After 1929 came the Great Depression, a decade of suffering. After 2008 came global recession and a decade of stagnation. This time, the numbers are bigger, the connections are tighter, the trust is thinner. We are not approaching the pattern, we are inside it. Empires fall, banks collapse, markets crash. But individuals who recognize patterns can prepare. Here's what history teaches. First, diversify your foundation. Do not keep all your savings in one institution, not one bank, not one country, not one currency. Split your exposure. Keep operating funds in a large national bank. They're too big to fail and will get bailouts. Keep midterm savings in a regional bank with strong balance sheets, lower risk exposure. Keep long-term assets in a brokerage account, stocks, bonds, separate from the banking system. The goal isn't perfection, it's avoiding single points of failure. Second, understand FDIC limits. Federal insurance covers $250,000 per depositor, per bank, per account type. If you have more than that in one bank, the excess is at risk. Above the limit, you're not a depositor, you're an unsecured creditor. And in a collapse, unsecured creditors get wiped out. Third, hold hard assets. Paper promises can be broken, numbers on screens can be frozen, digital accounts can be blocked. But physical gold can't be printed, silver can't be hacked. Productive land generates value regardless of financial systems. Hard assets have preserved wealth through every collapse in history. Rome, Weimar, Germany, 2008. They will preserve wealth through the next one. Fourth, cash positioning. In a crisis, liquidity is power. When markets panic and asset prices collapse, cash is king. Those who hold cash during a crash can buy assets at 10, 20, 50 cents on the dollar. The Rockefellers did it in 1929. Warren Buffett did it in 2008. The prepared will do it in the next collapse. Fifth, relationships matter. Know your banker personally, not just the teller, the branch manager, the regional director if possible. When systems fail, personal relationships determine who gets access. Small, well-run regional banks often survive when mega banks freeze operations. Local bankers who know you personally can make exceptions during chaos. In every financial crisis, proximity to decision makers is leverage. Preparation isn't paranoia. It's not pessimism. It's discipline. Every empire that collapsed left survivors. The ones who recognized patterns early. The ones who acted while others ignored the warnings. You don't need to predict the exact date. You just need to be ready before the crowd realizes what's happening. Because once stage 4 begins, once the cascade starts, it will be too late to prepare. Banking crises are not accidents. They are not caused by bad luck or black swan events. They are the mathematical result of repeating human behavior. The names change. Spain's silver-backed defaults, Britain's pound collapse, America's subprime meltdown. The tools change. Railroads in the 1800s, mortgages in 2008, commercial real estate and crypto in 2025. But the pattern never changes. Credit expands beyond sustainability. Assets inflate into bubbles. Shocks arrive when confidence cracks. Cascades follow when trust disappears. Bailouts come too late to prevent pain. Right now, in 2025, we are deep into stage 3. The shock has begun. Stage 4, the cascade, is coming. Stage 5, the bailout and debt explosion, will follow. The only questions left are, how fast will it happen? How severe will it be? And who will be ready? Recognizing the pattern is the first step. Acting on it is the second. Most people will ignore the warnings. They'll believe this time is different. They'll trust that governments and central banks have everything under control. They always do, until they don't. History isn't repeating, it's screaming. If this opened your eyes, subscribe, because when stage 4 hits, when the cascade begins and panic spreads, you won't have time to research. You won't have time to plan. The next video breaks down exactly which banks are most exposed, which sectors will collapse first, and the 72-hour action plan for when trust finally breaks. The pattern has repeated twice in 100 years. Each time, millions lost everything. Each time, a few who understood the pattern thrived. The pattern is clear. The only question is whether you'll be ready or surprised.